We're going to calculate the stock price for Parkland Fuel. The ticker is PKI.TO. The TO stands for Toronto. And the first step is the market cap, which is 5.75 billion. Next, the stock price, which is 38.72. So now to figure out the shares outstanding, you just take the market cap divided by the stock price, and you have 149 million shares outstanding. Next is free cash flow, and the best way to figure out the value of a company is to estimate future free cash flow and then discount those dollar amounts back to today's dollars. And that's exactly what we're doing here. So free cash flow is positive every year. That's a good sign. A lot of companies, people ask me to value, have negative free cash flow. Now the income statement, which is the profit or loss, and the last is revenue. We had a nice pop in revenue the last couple of years. Went from 6 billion to 9 billion to 14 billion to 18 billion. That's really good. Net income has been growing. This looks like a solid company so far. But it doesn't really matter how the financials look. It matters what it's trading at. It might be trading at a really high price. So we need to figure out the capital structure so we can discount the future cash flows. So let's see the interest expense, which is the interest PKI pays on its debt, 226 million, and the debt can be found in the balance sheet. Go to liabilities section, and then the current debt, 115 million, and then long-term debt, 3.8 billion. So they pay a pretty high interest rate, 5.74%, but interest is tax deductible. So let's find out their effective tax rate. So the income before tax, 547, and the income tax is 133. So they pay 24% of taxes. So the cost of debt is actually 4.3%. And 41% of the capital structure is debt, which isn't the best sign, but it's not terrible. At least it's not over 50%. Let's figure out the cost of equity. Let's find the beta, which is the volatility, 1.59. And then calculate the cost of equity. We just use a CAPM model, capital asset pricing model, and the cost of equity is 14.5%. So the reason equity is more expensive than debt, as you can see, is because equity sits lower on the capital structure of a company. So in the event of a default, debt holders are paid before equity holders. And usually equity holders don't receive anything. So the WACC is 10.4%, and that's the what it costs this company to obtain financing. And this is what we need to discount the free cash flows by. So when a company makes an investment decision, they look at the WACC and see, is the investment going to give me a return that's greater than the WACC? And if it's not, then they don't go through with the investment. And if it is, then they do usually go through with the investment. So let's see what the discounted cash flows are. We estimated them already based off of the financial information, and then we discounted those dollar amounts back to today, and the value of the company is 8.7 billion. When you divide it by 149 million shares, you get a calculated stock price of $58. So it is trading at a discount, a 34% discount, because the stock's trading at 39. So 58. So it was trading in close to in the high 40s a few months ago. Then it dropped like everything else. So it was trading closer to intrinsic. Now you have to make the decision, will it go back up? Does the future of the company look as good as the financials do? That's your decision. And if you do more research, you'll find some analysts saying that this stock's a buy, while other analysts are saying this stock's a sell. But each analyst uses their own model and their own assumptions, but you never actually see their model. But this is my model and my opinion. So thanks for watching.